Hello, welcome back. It's Green here. We're going to go over a part two for the structure video. As mentioned, we spoke about the fail to close candles, and I didn't want to go into too much detail in the last video purely because I wanted to go and explain exactly how to identify them, what they are, and then how we can build up our higher time frame bias into our lower time frame bias using them as an additional confluence to structure, as they are really just the cause of a liquidity sweep, but just a different name. Because for me, I find it easier to understand as they fail to close, because they fail to close above or below the protected highs and lows. So as you can see to the left hand side here, we have a example of how a candle fails to close above the protected high, which would be then a fail to close. Then price moves down and creates a move to the downside. This then allows us to understand that we are having a liquidity grab to the highs. Same again on the right hand side where we have the example for the low. Protected low is swept, price moves up, and that shows us that we are having a fail to close on that move. If we have the fail to close causing a momentum shift or a change of character, then we are going to understand that there is a lot of BFIs or big players in the market getting into here and using the protected low or the protected high as their limit orders, as retail potentially are buying these out or people are having their stops on there, which means that there will be a buy stop into the market there and a sell stop into the market here, where when it sells back or buys back due to the stop loss, then price will go in the opposite direction. So now we understand a little bit of what fail to close is. I'll show you an example from last week on S&P 500. We'll go over the last example that I did in the previous video as well in more detail, as this can then, you can use that first video to then go to the second video and use them in tandem to make sure that you understand the process of putting structure and liquidity together, as a lot of people just use one or the other on their charts, but to use both, this can create a higher probability of being on the right side of the market. Hopefully I don't go back over the same things too much as I did in the previous video, but how we see break a structure up, break a structure down. This is what I didn't go into very much, the FTC, like I mentioned. So we look at wick here. A lot sitting on this. So when price is raided and pushed back down, we get a change of character. This significance here, where the fail to close, which then creates the change of character to follow structure, is what we are looking for within the internal structure. So to dim it down a little bit, we obviously know what internal structure is due to the last video, but to go over it again, the internal structure is the small moves which happen to pull back to the swing structure, which is here. So we're overall bearish. The change of character indicates the change internally to the downside, which is caused by the fail to close candle, or we could call liquidity sweep, whichever one you want to call it. But in this case, it's the fail to close. Now, this was the real reason of the push down. It was just a matter of getting the entry that I required to take it further down. But I will go over a fresh example just so from the start, just so you can see how it's marked up step by step and how you can utilize this into your trading. So here is the second example here. We'll start from the left, move to the right, and understand why we entered this through using swing structure, optimal trade entry model, internal structure, and the fail to close. So we have a break of structure to the upside, very impulsive move at the end of New York session in the afternoon. We then look for a pullback on the optimal trade entry. So we use the whole movement here. 0.62 to 0.79 is what ICT teaches, and this is exactly the same as what I use. I do like to know what the equilibrium is, just as an additional confluence to look where price could potentially create a significant move from, but we are looking at the 0.62 to 0.79 area. So whilst we're coming into here, we have a fail to close to the downside. However, we don't see any aggression moving up. We don't see orders going into the market. We don't see a pull up as it taps. It just doesn't tap, so it's not even important at this moment in time. However, we got an internal break of structure to the downside. This now being the protected internal. Then we get a push back up, and then we get a fail to close. So this now becomes liquidity. Is price going to look to take it higher? However, it does. So we are looking to see what price is doing to the upside. We see a massive momentum candle in line with the break of structure to the upside on the swing structure. This now creates an internal break of structure to the upside. We have the fail to close, which has grabbed liquidity from the lows. We have used this fair value gap here, or the imbalance on the left hand side, to mitigate and cause price to move up. As ICT mentions, the algorithms are wanting to get as many orders into the market as possible. So this is an additional confluence that we could look for to back up our understanding of why price in the OTE model would want to push up at this exact point. This is a new concept that I'm looking at, the candles, understanding what the candles are doing, the momentum. Price is very bullish coming out of this range, which creates the break of structure on the internal. So when we see this here, we are now structurally aligned. We have the break of structure on the swing. We have the internal break of structure. That creates the structural alignment. We have the liquidity sweep, which is the fail to close. And now we have the momentum push up. So for me, now we are looking to take buys, and we are looking to take this high. On this example, I probably wouldn't look to take the high purely because of trading in London. We may get the high taken in New York. However, I look for like a 2.5 free risk to reward trade. It all depends on the size of the stop loss. When having a $4.8 stop loss on S&P in London session, I don't believe targeting this high or having a 2.5 or free, well, we have a 2.5, having a free risk to reward is optimal. I'd look for 2, which is here, or 2.5, which it hit. This is only in for an example. I will be honest, it wasn't taken. It was just what I came across when I was testing this system. So hopefully this example, as well as the previous example which we went over, can add to your understanding and your education, and you can go and back test this for yourself in TradingView, marking out the breaks of structure, the internal break structure, and now the fail to close as liquidity sweeps in confluence with internal breaks and breaks of structure.